Welcome to our YouTube channel, Trowbridge and A Law Group. We're syndication and securities lawyers. Today we're going to talk about understanding capital accounts. You can contact our firm about our information by calling the general office number, and that'll connect you to one of our three partners. You can go to our website and see all the information that we have at the website. And one of the things you'll be able to do there is to get a free copy of the 5th edition of my book, which we'll talk about at the end of the presentation. But understanding capital accounts is really important because this is an IRS issue, but when you invest in a LLC or a limited partnership, you get a capital account, not a W-2 or not a 1099. You get a K-1 that reports the results of your capital account. So it's important for us to know about that. And I've been a real estate syndicator and attorney for a very long time. For about 20 years, I was a syndicator, been a real estate broker and teacher for a long time. Went to law school at 45 and ever since been practicing one type of law, securities laws, and once again, offer of the new book. I'm an old runner, just retired really this year. After the last 15 years, I ran 47 half marathons, and that's enough. So my discussion today is understanding capital accounts for investors in LLCs. This would also apply if you're investing in limited partnerships, but not many people do limited partnerships today. So what does an LLC do? It tracks capital. It tracks your capital in an LLC. It's an IRS set of rules showing up on the K-1. Well, what about the K-1? What does the K-1 do? Well, like I said, it tracks capital. And everyone's K-1 in an LLC starts at 0. Then you make your capital contributions, which adds to your capital account. When you get cash distributions, that subtracts from your capital account. When you report taxable income, that adds to your capital account. And when you deduct taxable losses or take taxable losses that are reported to you, it subtracts from your capital account. And when it's all said and done through a series of transactions, your capital account ends at 0. Starts at 0, ends at 0, and all the way through it's measuring what do you actually have in this account and this investment. Cash distribution and economic interests are two different things, and you're going to see as we go through. Here's an example where we have a cash flow in a property of $150,000. We have reserves of $50,000. So there's cash to be distributed to the members of $100,000. In this example, it's an 80-20 split. The members will get 80, the manager will get 20. So the members are going to get $80,000 and the manager will get $20,000. So we're looking at the capital account of a 10% member. Remember, our capital account starts at 0. This member invested $100,000. So their capital account went up to 100. 10% of the 80,000 gets distributed to this investor. So now his capital account has gone down 8,000 because he's taken money out of the deal. So his adjusted capital account from cash distribution is $92,000. So the cash distribution decreases his capital account. Now let's see what else might have happened. During the operation of the property, we have NOI. We can deduct interest paid. We can deduct the cost recovery we've taken, cost segregation, bonus depreciation, whatever it is. We now have taxable income or loss. In our example, it's $50,000 of NOI. It's $350,000 we paid in interest, and our depreciation and our cost recovery is $300,000. So 500 minus 350 minus 3, we have a taxable loss of $150,000 to share with our investors. At an 80-20 split, the members will get $120,000 of the taxable loss. Remember, they got $8,000 of distribution, but there's also something else going on in here. The $120,000 of taxable loss shows up in their capital account. So for this first year, our 10% investor got $12,000 of loss allocated to them, 10% of the 120. That's going to decrease our capital account. We started at zero. We have 100,000 we invested. We got 8,000 of distribution. We had 8,000 of 12,000 of loss allocated to us. So our adjusted capital account at the end of 1 year is $80,000. One of the reasons I think this is important is as a syndicator, every year we used to send out our K-1s to our investors. And it was not unusual for an investor to give us a call and say something like this. Gene, I invested $100,000 this year, and the K-1 I have says my capital account is only $80,000. What happened to my $20,000? I invested $100,000. So it's not unusual for the investor not to understand what's going on in their capital account. When I was syndicating, I got to the case that in January, I would send all my investors a short 1 or 2 page letter with an example like this of how the capital account works. So when they got their capital account, when they got their K-1 and the end of the year reporting, they would know how much distribution they received, how much loss allocation they were given, and they could figure out why their capital account went from 100 to 80,000. So that was a good thing I did, and I still recommend that to my clients today, that they do some education around the capital account to their investors. Cash distribution isn't the same as taxable income. We might have gotten $8,000 in cash distribution, but we actually had a negative taxable income of $12,000. So just because you get cash, that doesn't mean it's taxable. It could be offset by the taxable income. Here's an example of the same investor. After 5 years, we held the property and we sold it. The results of the property sale 5 years from now, or after a 5-year hold. The property is sold and we ended up with $2 million to distribute, okay? An 80-20 split. The members are going to get $1.6 million. The manager is going to take their 20%. So here's the total, the sum total of 5 years in this investor's K-1 in his capital account. His beginning balance was zero. He invested $100,000, increasing his capital account. He took $12,000 worth of losses each year for 5 years. The investor got $8,000 of cash flow each year for 5 years, and the investors got $1.6 million, $160,000 at the end of the 5 years from the cash distribution. So the capital account started at zero, it went up to 100, then it went down 60, down 40, down another 160. So our capital account balance at the end of the 5 years is $160,000 negative. How do you adjust capital account? How do you increase the capital account? Because we need to get back to zero. Well, what you do, you get an ending entry of $160,000 of taxable income. That will bring your capital account back to zero. Okay. Now, a topic for another discussion is how does that $160,000 of taxable income get taxed? Well, it might be ordinary income through recapture. It might be capital gains. You might be able to do a 1031 exchange and postpone or defer the actual reporting on your income tax return of that $160,000 adjusting entry. But that's the way it works. It starts at zero, it ends at zero, and the ending entry is always the adjusting entry that gets you back to zero. Now, in the 5th edition of my book, the 2 chapters on IRS rules and accounting procedures will go through maybe a little bit more detail of an example of capital accounts, including the passive loss rules for both the investor and the company, because the company has a capital account that goes the same way, starting at zero and ending at zero. And one of the issues there is the manager. We noticed that the manager received cash and the manager received tax losses. One of the issues is what's the manager's capital account? Did the manager invest anything? If all they did is get cash flow distributions and taxable loss allocations, they're going to have a very negative capital account, and they're going to have a very big adjusting entry of taxable income to get their capital account back to zero. But that's a topic for another YouTube presentation. So to keep in touch with us, go to book.tnllp.com and we'll send you a PDF of my book, the newest edition. And that'll be good for you. If you want to buy a book, there's a way to buy a book at the website, or you can go to Amazon. So in any way, contact us if you'd like to talk to us. Call the main office and you can set up a consultation with one of the 3 partners. And you can see the interesting information we have on our website. And our YouTube channel is always accepting or placing new YouTube videos like this one. So be sure to subscribe. And then when you subscribe, you'll know what's new and you'll be able to join me again with some new information. This is Gene Trowbridge saying, see you next time.